Hi, everybody. My name is Brian Carlson. I am from GCG Financial, located just north of Chicago. I'm the Vice President of Wealth Management here, and we focus on individual financial planning within the medical community. So assisting pharmacists out with whether it be insurance-related products, life insurance, disability insurance, long-term care insurance, investment-related products, such as IRAs, other retirement accounts. Roth IRAs are very popular amongst younger pharmacists, regular brokerage accounts. Or we also assist people with general financial planning, and that's basically becoming their holistic CFO, where we know more about their financial situation than they know about their own financial situation. We cover their debts, their insurances, their investments, their student debts, their credit card debts, their mortgages, their budget, which is extremely important. And we give them guidance on exactly what to do and when to do it in order to accomplish whatever goals financially that they are trying to get accomplished. We work together as a partner. That's very important to understand, is we take a very educational approach to our planning. We want to make sure that you have a great idea of what you're doing and why you're doing it. And so what we're going to be discussing here today, we call it the financial well-being for pharmacists. And we can get very, very detailed on a lot of these topics that we're going to be discussing. As you can probably imagine, the financial planning world is very, very complex. I'm going to try to simplify it and speak more about real world examples and real world topics. So hopefully anybody who's listening to this can take at least one piece of this conversation and apply it to their own financial well-being. So I'm not going to get, and that being said, I'm not going to get into many granular details on specific items. We are wide open to questions. So if you watch this, please feel free to send us questions or ask questions. You'll have all of our contact information. We're more than happy to assist anybody when it comes to this presentation if you have any follow-ups. But again, I'm going to focus on real world items. This is also focusing on everybody who's in attendance here, pharmacists, residents, and students. I'm not talking to somebody who's been practicing for 20, 30 years, or even 10 years at this point. We're going to be talking about specific tools and steps that you should be taking right now, whether you're in your residency, whether you're about to finish your residency, or whether you're in schooling and or about to go straight out working post-schooling. So follow along and we'll get through this. And again, any follow-up questions, please don't hesitate to ask. There are many slides in here. I'm not going to go through every slide. I believe everybody will have the opportunity to review the slides. I'm going to focus on the most pertinent slides that carry the most value, and I like to have a much more of a conversational kind of presentation versus just reading off the slides here. And so if I click on a slide, I might not actually address it specifically, but I'm going to give you the opportunity to read it. Obviously, a medical exam versus a financial analysis, we actually approach this very similar to how physicians approach when you're going into their office. Anybody prior to coming into our office always needs to fill out a questionnaire. We need to get a good sense of where they are financially and their knowledge base financially as well. Otherwise, we can't guide you properly. So any financial advisor that you work with, please keep in mind that you need to have open and honest communication is vital. And that's both ways. That's from my perspective, talking to my clients, and it's from my client's perspective as well. And the financial, I call it the financial questionnaire that most financial advisors provide to their clients or prospects of people who are not yet clients is really valuable to the financial professional to get a good backing on what the person has done previously and what the person is trying to get accomplished. So make sure you keep your communication as open and as honest as you possibly can be to your financial advisor. All right, the financial planning pyramid. This is really where we're going to spend the majority of our time here tonight. I can talk about this pyramid here for an hour plus, breaking up each individual component of this pyramid. It's a financial planning tool that gives you guidance on where and when to start your financial life. It breaks it down very nicely because we all understand that a strong foundation is very important to anything that we do. And it's similar to if we're building a house, if we're building a building, if we're building a financial plan, we need to build that strong foundation first. If that foundation isn't solid, everything can crumble down. So it's extremely important. What we're going to be focusing on here in this conversation, we're only going to be focusing on the bottom here. That's all we're going to be doing. because anybody who's in residency or is a student right now should be disregarding all of these up here. Now, please keep in mind, I'm speaking in general terms. I don't know anybody individually from a financial position. I don't know if there's any inheritances. I don't know if there's any working spouses of a different income classification than a student and a resident. So please keep in mind, most residents and students should only be focusing on the bottom here. The first one is a property and casualty insurance. This is your homeowners, your renters insurance, your auto insurance, your umbrella insurance. A couple quick comments on here is everybody who has a car has auto insurance, because if you don't and you're driving in the state of Illinois, you're breaking the law. It's against the law not to have auto insurance in the state of Illinois. Many people, though, we are quite surprised when we call these audits, when we review people's financial positions, we are quite surprised that they don't have the proper auto insurance. Now, they might go and click on a random website and just enter all their information, and then out pops the cheapest quote out there. That's fine. We're totally okay with it if that fits your position in life, and if it also fits your financial position. You need to make sure that you have the proper liability coverages put into place. It doesn't matter if you're a student or you've been out practicing for many, many years. Having the proper liability coverage is extremely, extremely important, because it can only open up a can of worms for undue future hardship if you don't have the proper liability plans put into place right now. As an example, if you get into a car accident and your auto liability pays out, let's just say a total of $100,000, but you run into a building or there's bodily damage, bodily injury, the damages are going to occur, are going to be worth much more than $100,000. Well, what if that person or that company sues you for $1 million? What happens? I can't tell you, in my 19 years of business, I should say, I'll kind of give you a little history there. So I've been practicing for 19 years. I've been with GCG as a certified financial planner for the past 17. And that's when we've really dived deeper, really deep into people's financial situations. In the past 17 years of being a CFP, a certified financial planner, when we're reviewing plans, I can't tell you how many people are underinsured in their auto liability. And this is not something that we sell. It's not something we advise upon, but we advise them to talk to their agent. We advise to talk to somebody else to get the proper liability plans put into place. I've had so many young professionals tell me, it doesn't matter. They can sue me for 10 million. They can sue me for 20 million. It doesn't matter because I don't have the money. The reality is that they will sue you for that. And the reality is you will be stuck paying that. Now you might say, how am I going to pay that? I don't have the cash. Well, then there's a little legal clause that's called wage garnishment. And that actually falls right here too under the asset protection clause. So what wage garnishment means is if you do not have the assets to pay off a lawsuit, federally, the federal government will garnish your wages until that lawsuit is paid off. It's taken directly out of your pay. So for somebody who does get sued for that $1 million, who only has $100,000 of liability limit, they're on the line for that $900,000. If they don't have it, there will be wage garnishment put into play. Now, one very, very easy and very, very inexpensive way to protect against wage garnishment is to purchase what we call an umbrella policy. Yeah, just like it's raining, you're holding an umbrella up, it's an umbrella policy. An umbrella policy is over and above your homeowners, your auto, your renter's insurance. And what it does, it gives you extra liability limits. And so in this case where you're sued for $1 million and you only have $100,000 of liability limit, the umbrella policy will pay out that extra $900,000. And when that umbrella policy pays out that extra $900,000, it relinquishes the ability of that person to seek further damages from you due to that occurrence. Again, it's an umbrella policy. It's very, very inexpensive. You're talking about maybe $100, $150 a year per $1 million of coverage. The rule of thumb is to get at least 10 times your earnings in the umbrella value. So if your earnings are 100,000, you need to get at least $1 million of coverage. If your earnings are 200, you get $2 million of coverage. Now I know when you're going through your residency and your schooling, the income is completely different or non-existent from the schooling perspective. $1 million is a basic starting point for an umbrella policy. So if you're curious, you think, well, I don't know exactly what to get. At this point, you're safe with $1 million. Once you're out practicing, once you're out working and you start earning more and you start developing and obtaining new toys and homes, then you would want to have that reevaluated to get that increased. But again, the umbrella policy serves as an asset protection tool. Serves as an asset protection tool. It also falls underneath the property and casualty umbrella right here. So the next one is renters and homeowners. If you own a home, you definitely need to have homeowners insurance. If you rent a home, I'd strongly encourage you to get renters insurance as well. I mean, I live in the northern suburbs of Chicago. Many people who are going to be listening here live in the Chicagoland area. There are floods, there are fires, there are thefts. Stuff happens. Your landlord is not protected if anything happens inside the unit. So I should say you are not protected. Your landlord is protected because the landlord's protection from their building maintenance insurance is outside of the drywalls. Anything inside of the drywalls is 100% your responsibility. So for those of you who have renters insurance, you know it's very, very inexpensive, maybe a couple $100s a year. For those of you who don't have it, I strongly encourage you to obtain it. And you should obtain it by going to your auto insurance person, whoever that auto insurance carrier may be. Let them know that you want to get a renter's policy. Let them know that you want to get a multi-policy discount, which will typically knock off 10 to 15% off your renter's insurance. I'm sorry, 10 to 15% off your auto insurance due to you having your renter's insurance. Sometimes that 10 to 15% discount is your renter's insurance. So you're actually getting that layer of protection at no extra charge. So it's a very, very important piece to have, and it's a very inexpensive piece to have as well. The next block being health insurance. Health insurance I'm going to skip over. It used to be a very easy conversation to have because wherever you work, you get health insurance. Now, if you're independent, if you own your own business, it's a little bit more difficult now to get health insurance. The one thing I'll stress with the health insurance aspect is if you qualify for an employer-based health insurance plan, you should get it. Don't go to the private marketplace if you can avoid doing so. If you can qualify for an employer-based plan, you want to make sure that you obtain an employer-based health insurance plan. That's simply due to the benefits and due to the freedom to choose where you're seeking coverage at. So for example, I actually don't know what happened in 2020, but Blue Cross Blue Shield, which is a major insurance company, if you had an employer-sponsored plan, you can go to Northwestern Hospital in downtown Chicago and utilize your health insurance. However, if you have a private marketplace individual plan and it's Blue Cross Blue Shield, you can't go to Northwestern. And so these individual marketplace plans are just not utilized, are not able to be utilized in as wide of an area from a provider standpoint. So the one thing I want to hammer home with the health insurance is if you have the opportunity to jump on somebody's what we call a group or employer-based health insurance plan, I will strongly encourage you to do so. To continue the insurance path, so we have both disability and life insurance. I'm going to talk about life insurance first. So life insurance, please note that you do not have a need for life insurance unless you have somebody who's truly financially dependent upon you. If you have children, if you have any type of situation where somebody is financially dependent upon you, you need to get it. Don't even blink an eye. You go out and you get it. Even if you have a cosigner, so this is a very common example for students. If you have a cosigner on your student debts, if you were to pass away, your cosigner now becomes responsible for your student debts. The way that I look at that is if mom, dad, brother, sister, friend, parent, whoever it may be, loved you enough to co-sign on your student debts, love them enough to pay $10 a month on a very inexpensive term life insurance contract to protect them. And what I mean by that is if they co-sign and they're responsible for, let's just say $300,000 of student debt, and you were to pass away, you can obtain a $300,000 term life insurance contract for roughly $10 a month. And that would provide protection to them. That would provide a death benefit to them, which would then give them the ability to pay off the student debt. So it's just a workaround to get, again, greater peace of mind, where you don't have to necessarily worry about that cosigner because you took it upon yourself to take on some extra adage on paying $10 a month for a term life insurance contract to provide them protection. So that's the time when we recommend buying life insurance, when you have debts, when you have a cosigner. But going back to the children aspect and the working and the non-working spouse aspect, that's when you definitively need life insurance, because you want to make sure that your family can continue to live the lifestyle that they are living now if you were here providing for them. Life insurance is not a lotto ticket. Life insurance is a lifestyle continuance ability type of a tool. Now, there are many different types of life insurance. As you can see right above here, it says permanent insurance. I'm sorry, it keeps flipping on the next page. The permanent insurance. So the permanent insurance, that's not something that I would recommend when you're in training or in any sort of level, because it is requiring a much higher outlay. Now, there are definitely advantages to permanent insurance, so don't blink an eye when somebody tries to advise you on it later on in life, because there are strong advantages from a taxation standpoint specifically to permanent. But really, when you're in training, you're focusing on just term insurance for inexpensive protection that gives you some flexibility. The most important piece, though, is the disability insurance. Disability insurance, I can't stress that enough to anybody who's listening to this. If you're in school right now, if you are going through your residency right now, don't even think twice. Just get disability insurance. Disability insurance is the most important piece of a young professional's financial plan, because it holds your financial plan together. If you are out of work for any reason, any illness or injury, how are you going to pay your bills? You know, we're living through it right now with COVID. I can't tell you how many people have been out of work, of our clients who've been out of work, not due to a disability, but just out of work. And I also can't even count on both my hands and my toes on how many people have actually filed disability claims over the past 6 months. And the reason being stress, anxiety, depression on what is to come, what's the next outlook. And those are all considered disabilities. And disability insurance, the best way to look at it is it's paycheck insurance. If you cannot perform your occupational duties due to some illness or injury, the insurance company reimburses you. They provide your paycheck to you. The younger you are when you obtain the coverage, the less expensive it is. The younger you are from a health-based perspective, the easier it is to obtain. Please note, once you have a contract locked in, the premium is locked in, the premiums don't change. So if you're paying $1 today, you're paying $1 in 20 years. And that's the benefit of locking in at the youngest age possible. The other thing, from a health aspect, it's very difficult to qualify. If you've ever seen a chiropractor, a psychologist, a psychiatrist, any type of a counselor, if you have broken bones in the past 5 years, you're gonna have a difficult time getting a disability insurance contract. They're very, very picky on who they insure as well. As of July 1st, 2020, companies have made modifications. Unfortunately, again, due to COVID. COVID has touched every industry, and they've weakened the benefits. They anticipate, it's not out there yet, there's nothing official out there, but all the insurance companies are telling us that they will be weakening the benefits even further as they pass new insurance codes, because all insurance codes new insurance codes are being passed right now due to the unfortunate situation that we're in. And when insurance codes get passed, please keep in mind, they don't better the products. They always make them worse. They always make them more defensive. And so when you can still get, there's still 4 good solid contracts out there for pharmacists. That's it. There's only 4 good disability insurance contracts out there. When you can get them, they're still out there. I strongly encourage you to lock them in. Last 2 things on disability insurance. Females, please know that you do pay twice as much for disability insurance than your male counterpart pays. The reason being, pregnancy is considered a disability. I should say complications of pregnancy is considered a disability. And also the statistics show that females take much better care of their bodies, therefore they seek treatment more often, therefore they file claims at a higher rate. The reason why I bring this up is because we get phone calls all the time from women who say, well, I was talking to my peer and he is paying half as much for his disability insurance. Well, the key word there is he. Yes, females do pay about twice as much for disability insurance than males pay. So I just want to make sure that you know that. The second is discounts. When you're in training, the insurance companies look at you as a bullseye on a dartboard. They say, hey, I want you as a young professional, as a policy holder of my product, because you're going to have this policy hopefully for many years into the future. So they incentivize you by giving you discounts as well. So if you obtain a contract only while you're in training, please keep that in mind, whether you're a student or a resident. While you're in training, you get discounts, and the discounts are between 10 to 20% depending upon the company. That's huge. It's tens of thousands of dollars over the life of your career. And the discount also does not disappear after year one. It lasts you every single year throughout your entire career. Even if and when you add on protection later on as your income increases, you still get what they call the in-training discount because you obtained your original policy when you were in training. So it's really, really important to secure a disability insurance at the youngest age possible, not only from a health basis, but also keep in mind from a price aspect as well. The next two on here are qualified retirement accounts and cash reserves. So we're going to talk about both of these in a second. So I'm going to go through here and give you a couple of data points. Again, some of these slides, really the next 4 slides, I'm going to allow you just kind of quickly glance and read on your own. I think they're pretty straightforward. Work with an advisor you trust. Keep score is basically keeping track of your budget. Manage debt is extremely important to young professionals coming out right now. The one thing I'll comment on managing debt is we don't look at student debt as being student debt. We look at it as being business debt. Now that you have this debt, you need to look at this and say, you know what, how am I going to pay this debt back in the most tax and cost efficient way? Almost all good business owners take on debt to build a practice, to build a business, but then they're strategic with their thinking and they think, how am I going to get rid of this debt in the most tax and cost efficient way? You should be doing the exact same thing with your student debt. And planning ahead. You know, we talked about the property insurance, we talked about income, which was disability insurance. We're briefly talking about life, but now we're going to talk about these next two, building a cash reserve and building some long-term wealth as well. So here's a quick stat on disability insurance. This is a fun slide, so I am going to leave this up here for a second. It's talking about your income being your most valuable asset and projecting out how much money you're going to earn over your lifetime. So if you're 30 years of age and you start working, making $200,000 a year, as you can see, you're going to make roughly $24 million over your lifetime. I know that seems like monopoly money, but it's math, and math doesn't lie. That's a beautiful thing about it, and it's the reality. And this is why disability insurance is so important, is because your disability insurance protects this number right here. This is along the line on the disability protection as well. Where's your money going to be coming from? Yes, we have family, friends. You can't get loans. Keep in mind, you know, this is a play here. You can't get loans if you're on disability. Savings and assets and family, it's all going to disappear quite quickly. But one of the other things I want to make crystal clear to young professionals is there always comes a time when we need to grow up and take care of ourselves and not necessarily rely upon family and friends. Even though they're there for you, they love you, and that's fantastic, but we need to take care of ourselves. So that's making sure that we step out of our comfort zone a little bit to secure the plans and products that do that. I'm going to skip through these disability and life insurance portions because I want to get more to this slide right here. So in regards to paying yourself first, this is one of the most important pieces of financial planning, is making sure that you treat yourself as a bill, as a monthly bill. You know, you need to set aside a specific amount each and every month. It might start with $1, and then next year it increases to $10, and then it goes up to $100, and it goes up to $1,000. One of the key things with treating yourself as a monthly bill is you're starting to create a habit for yourself. And as you create a habit, if you don't do it, you're going to feel really, really poor about yourself. And you're going to kick yourself in the butt to do it again and to get that savings goal going again. It's like going to a gym. For everybody who's a gym rat or people who ride bikes or who jog, you know, if you don't do it that one day, you kind of feel bad about yourself. And then you kick yourself in the butt and you go harder the next day. And it's the same thing in the financial world. Set aside a certain dollar amount and keep it going. Create that habit. And what that habit eventually will do, it's going to create your wealth. So this is just taking into consideration two people, as you see Mr. Early up here and Mr. Procrastinate, both putting away $5,000 a year. But you see the ages that they start at, 35 versus 29. So Mr. Early put away a grand total of $30,000 more. But look at the monetary difference down here at the age of 65. $30,000 more turned into roughly $400,000 of additional wealth. Again, this is math in the financial planning world. And the reason behind this is due to compounding interest. compounding growth of assets. Now, people always ask them, where do I put money? Where can it compound? Well, that's where this next slide comes into play. This slide right here comes into play. So when you're looking at compounding growth, you're always looking at tax qualified plans, such as IRAs and 401ks and insurance and college savings accounts. I think this is a very valuable slide because it talks about the different tax benefits and consequences of various investments. So for example, in the green bucket here, this is your paycheck money. This is money that was taxed already. It goes into the bucket. And as it grows every single year, you're paying capital gains and income tax. So there's no tax benefit to this money. It's paycheck money. In here is your paycheck, your checking account, your savings account, your regular brokerage accounts. Inside the middle bucket is what we call the tax deferred money. This is inside of here is a 401k, a 403b, traditional IRA, a 401k and a 403b, just so everybody's on the same page. A 401k is for a for-profit organization. A 403b is if you're working for a non-for-profit organization. But it's a pre-tax benefit, so the money goes in pre-tax, it grows tax deferred, but when you take it out, you pay taxes on it at that time. If you take it out prior to the age of 59.5, there's a 10% penalty. And I do apologize, based upon the new tax code, this last year, it should not be age 70.5, this is now age 72. So this was a change that was implemented based upon the new tax code. It's age 72 right here. But basically what it is, you're being forced to take money out at the age of 72. Now, really, we don't know if this bucket is a benefit to us or not. Right now, historically speaking, tax rates are very low. The highest federal tax rate is 37%. It doesn't matter which side of the aisle you're on, right or left. It's very, historically speaking, it's very, very low. We all anticipate tax rates going in one direction. We anticipate them going up. You look back in the early 80s, you go back to the 1950s, 60s, 70s, and 80s, those 4 decades, highest tax rate was 75%. 75%. We're at 37% right now. We had tax rates in the, in the 90% for 5 decades. So again, highest tax rate now being 37%. Historically speaking, it's very low. We're not telling you the tax rates are going up to 75 or 90%, but what I'm saying is it is a reality, it is a possibility. And so we don't know if this is actually a beneficial bucket to us or not, because we're putting money in, we're getting a tax break on the contribution, but then the money grows, and when we take it out, we pay taxes at that time, at the income tax rate at that time, which is unknown. So then there's the blue bucket. The blue bucket is money that was started in the green bucket, so you've been paid, it's in the green bucket, and then you take it and you deposit it into the blue bucket. So this blue bucket, there's no tax benefits up front, but the money grows 100% tax-free. When you take the money out, it comes out 100% tax-free. So the blue bucket is extremely advantageous because it doesn't matter what the tax rates are. It doesn't matter if the tax rates are 20, 30, 40, 50, 60, 70, 80, 90%. The money comes out 100% income tax-free. Inside the blue bucket is anything called a Roth account, a Roth IRA, a Roth 401k, permanent life insurance, 529 accounts, which are college education savings accounts. These all fall into the blue bucket. We are big advocates of the blue bucket. 2 other additional things with the blue bucket. Unfortunately, a Roth IRA has income limitations. If you make more than $130,000 if you're single, or if you're married and your household income is greater than $190,000, you cannot participate in a Roth IRA. Can't participate, that's just the tax code. There is a workaround right now, it's been around since the tax year 2010, that allows people to get money into a Roth IRA by using a traditional IRA as a conduit. However, you need to be careful because if you do it incorrectly, there will be double taxation on your funds. It is one of these things that we recommend most people doing, but you just need to be careful. So talk to your advisor to make sure it's done properly, to make sure that you qualify for it, so you are not double taxed. That is, if you do not qualify to make a direct contribution. The other aspect for residents and students, you guys are all in a once-in-a-lifetime scenario if you have this opportunity. If you have any money that's sitting in a 401k, a 403b, or a traditional IRA, so in this middle bucket, if you have any money sitting in that middle bucket right now, you have the opportunity to turn it all into the blue bucket. Now, when you made these contributions, you were given a tax break. When you transfer it into the blue bucket, you're going to owe taxes on the money that you're transferring, but think about what your income tax liability is right now. Your income tax liability right now is very low compared to where it's going to be in the future. It's also potentially, if you're a student, it's lower than it was when you actually put money into this bucket over here. So if you're a student right now and you have money in this bucket and your income tax liability is 0 or close to 0, you actually got a tax break up front. When you transfer to this, there's going to be 0 or very little tax owed, and then all the money comes out tax-free. It's an incredible opportunity for young professionals to get both the pre-tax on the contributions and the tax-free withdrawals later on in life. Please do not let this opportunity slip by if you have money in the middle bucket. It is very time sensitive, so don't delay until December, because it needs to be done prior to the calendar year, prior to December 31st. It's crucial. The earlier you start the process, the better, depending upon where your assets currently are. It may take a month, it may take 2 months to get the money transferred over. And there have been some institutions, one specifically in the state of Illinois, that has taken much longer than 3-4 months to transfer money to the new account. So if you do have money in this, again, it's a very, very valuable tool. It's a once in a lifetime opportunity. Hopefully you're going to be going through the schooling thing one time. You're going to find your career, you're not going to have to do it again. So if you're in school right now or a resident right now and you do have money in this orange bucket, please, please contact your advisor, contact our firm. We can help you, your advisor can help you, but reach out to somebody because you're in an incredible situation to really enhance your wealth and take advantage of double tax benefits on the front end and on the back end. I'm going to go back to the pyramid here. So from a product standpoint, there's really only one other thing that I want to make sure that you cover, and that's the cash reserve. So cash reserves, it's an emergency fund, to keep it simple. It's cash that you have on hand to get you through any type of emergency. If you're out of work due to the current environment, if you are unable to pay bills, you need at least minimally, you need at least 3 months of your fixed expenses. Now, it's not 3 months of your income, it's 3 months of your expenses to allow you to pay the bills, you pay the mortgage, to pay the rent, to do everything else. Now, most people, when we're realizing, most people due to the current environment are realizing that, hey, stuff really does happen. You know, bad things do happen out there, and bad things happen that can put us in a very difficult financial position, not only from an insurance standpoint, but also from a savings standpoint. So many people are building up their cash reserves to a much greater amount. They're doubling it to 6 months, and many people are actually building up to 9 months of cash reserves just sitting there. I know it's not sexy, it's not fun, just talking about putting money in a bank account or a savings account, but it is a necessity. Stuff does happen. The economy does crumble at times, the markets crumble at times. If you are not properly prepared, you are going to be feeling the pain much, much greater than everybody else. Now, where to put that money? I do not recommend putting that money in brick and mortar banks. You need to find a high yielding savings account. You find a high yielding savings account. Now, high yielding right now, I will tell you, is paying only about 1%. High yielding 7 months ago was paying about 2.5% to 3%. High yielding a couple of years back was paying about 5%. So a high yielding savings account, even though 1% is not a heck of a lot, 1% is 100% more than 0% that the brick and mortar banks are paying. And so what you want to do is you want to keep your checking, your daily living expenses at your brick and mortar for the ATMs, for the cash withdrawals, just for the bill paying purposes, totally fine. But the rest of your money should be sitting in a high yielding savings account because you're earning a lot more money. The best way to make money is to have your money having your money working for you when you're not actually at your place of employment earning it. And so that's by transferring the money to the appropriate place. You'll still have your money over here in your one account for your brick and mortar, just like I mentioned, for the bill paying, for everything else. But then you link those accounts together and you have your savings growing in your higher yielding account. So we covered everything down here: the savings, the retirement accounts, the insurances, the property and casualty insurance. We touched briefly upon asset protection. I'm not going to go into a whole lot about it, but a couple things I'll say is don't ignore it. The reality is you're in a white collar profession. The likelihood of you being named in some sort of lawsuit is quite great. There are ways to protect yourself, but you need to take action prior to an occurrence happening. Because once an occurrence happens, anytime that you shift around is considered fraud. And because of your profession, I would encourage you to speak to your advisor to make sure that everything that you're setting up financially is being set up in an asset protected manner. That's a niche that we have at GCG, is we do not only comprehensive planning, but we make sure, because of our community that we work with from a professional standpoint, that asset protection is built into every financial plan that we create for people. So it is extremely, extremely important, because the last thing you want to have happen is a car accident happen 10 years down the road, or somebody comes over to your house and slips and falls and they sue you, and this is many years down the road and you've built up a big nest egg. You don't want that nest egg to be dwindled away. The last thing that I'll talk about is the debt management. As I briefly mentioned earlier, we don't look at student debt as being student debt. We look at it as being business debt. It's extremely important to take that same mentality. Please do so. The debt management aspect of it there's two schools of thought. There is, I believe that the federal government is going to pay off my student debt in X amount of years, depending upon the program. Now, many of you have probably heard that the likelihood, based upon the statistics that have been shown, of the debts being repaid over the past couple of years, it's very, very low. But that's fine. I'm not going to tell you to be on one side of the fence or the other. It's for you to make that personal decision. If you believe the federal government's programs are going to come to fruition and pay off your debt, you should be paying the bare minimum into those programs. Now, at this time, you should be paying nothing because of the deferment aspect, unfortunately, due to the COVID situation. But if you believe the federal government's going to pay off your debt, once your repayments start up again, be paying the bare minimum. If you do not believe the federal government's going to pay off your debt, you need to act quickly to refinance your debt, and to refinance your debt into the most competitive private lender that is out there. You're getting rates right now in the 3s and the 4% in private lenders. So you're cutting a few percentage points off, and we can structure a payment plan however you want to do it. Personally, I'm in this camp of making sure that we take care of ourselves. So if we have this debt, again, we're going to look at it and figure out what is the best way to pay it off. And right now, the best way is through the private marketplace. But that's for each of you to decide on where your beliefs stand with these federal programs that are out there. One key thing that people are concerned about when they refinance their student debt into a private lender is what I briefly talked about earlier, is, well, what happens if I pass away? What happens if I pass away? Then my estate, my spouse, my children are burdened with this debt. Again, that's where that cheap term life insurance comes into play. You buy it, you pay a couple bucks a month, and you have that protection. The cost aspect of the life insurance compared to how much additional that you're paying on the federal side, if you pay out many, many years and the government does not pay off your debt, the spread is ridiculously wide. And so don't let that be a deciding factor whether you're going to reconsolidate or refinance your debts in the private marketplace. The main decision is, how do you feel about the programs that are in existence right now, and do you feel that they will come to fruition? And will you qualify based upon where you're going to be working? If you do, that's fine. Stick with the federal debt. If you don't believe in it, or you're not going to qualify based upon your occupation, your job, your location, then go to the private marketplace as quickly as you possibly can. Debt is important. Many of you are carrying around a second mortgage right now. We need to look at the debt. We need to take the debt into consideration when you're building out your financial plan. It's just as important as all of these. The reason why these are on the foundation here is because we can take advantage of them first, and then we can build up. But the debt management and the asset protection, these are lifelong things. We're always going to be maneuvering debts around and strategically placing assets in certain areas. So the key with everything that we talked about here today is, the key to understand is there are so many moving pieces. There are so many different pieces within a financial plan as well. And each individual piece takes an area of expertise to tackle. Please don't go at it on your own. We do conferences as well. We call them the 5 financial mistakes that people make. And one of the biggest mistakes that we do see is people try to accomplish this stuff on their own. Focus on doing what you do best. Practice your trade as a pharmacist. Let a lender practice their trade. Let a financial professional practice our trade. Let a real estate professional practice their trade. Let an attorney practice their trade. It's you are going to be best off allowing everybody else to practice in doing what they do best, and you leveraging everybody else's area of expertise. One of the biggest mistakes that we see people make is them trying to do everything. From a timing aspect, you simply just don't have the time. And then from a knowledge base, you also just don't have the knowledge, and you won't have the knowledge in all these areas as well. Leverage everybody's area of expertise, and you'll get so much further in life from a financial perspective. I thank everybody for taking the time to listen to this information here. Again, Brian Carlson, Vice President of Wealth Management from GCG Financial, located in the Chicagoland area. Location, just as an FYI, just like this webinar, doesn't matter. We're part of the Alera network. We have 80 firms all across the country and locations all across the country. But if there's any way that we can assist you, please don't hesitate to connect. You have all of our contact information, and I look forward to chatting with all of you in a couple weeks as well on the live session to address any live questions. Thanks, everybody.